Again, in your report, you noted how loan demand will continue to improve throughout the rest of the year. But how is the current high level of inflation going to impact that? And by how much do you still expect loan growth to continue to accelerate?
Yeah, so I think the impact of inflation on the credit demand will be a little bit uneven across sectors, right? And I think in terms of the magnitude of the impact, that will also depend and heavily influenced by the monetary response, the monetary policy response that the BSP is intending to do. So if we are looking at, a very aggressive response, then what we're probably going to be seeing is that some borrowers, particularly, let's say people want to buy houses, and also some of the corporate borrowers, they probably want to opt to front load their loan requirements and to secure some of the cheaper rates, temporarily boosting loan demand. But I think on the overall, long-term view, basically this an elevated level of inflation, if it's prolonged, we think that the impact will be negative to the overall loan growth, as higher input costs and borrowing costs will basically impact the revenue outlook as well as debt servicing capacity of the borrowers. Now the thing is, right now for our base case scenario, we are looking at the inflation level tapering by the end of the year and going into 2023. So and we are also only expecting some sort of a gradual normalization in policy rates. So in this particular scenario, we don't think that the impact on the loan demand will to be very, very material. And also, I think the economy is strong enough to withstand and absorb some of the impact from such level of inflation.
Okay, now Tamma, you did also mention in your report that the asset composition of the banks is actually well positioned for rate hikes. What do you mean by this? Won't the margins be squeezed?
Yeah, so I think if you take a look at the mix in terms of those that are on floating rates and fixed rates, so I think a lot of at least the ones that we rate, more than 70% of the bank loan portfolio are actually on a floating rate. So which means that whenever there is going to be a revision in the policy rate, it's just very likely that they may be able to kind of reprice some of these loans, right? And with the liquidity conditions remaining relatively quite liquid, I think in general we are expecting some sort of an increase in margins for the rest of the year should policy rates continue to increase. And this has kind of been corroborated as well by a lot of the banks in an early part of this year during their earnings calls, and I think that's going to stay.
Okay, is the growth in loan demand mopping up the excess liquidity that is circling in the markets?
Yeah, I mean, I think to a certain extent, yes, it will be, but we are looking at a liquidity that is, almost on a record high, right? It is very high. Loan to deposit ratios are in all time. It is at 70% right now relative to 80% back before the pandemic. So there is still a lot of those right now. So a tightening in liquidity is actually relatively quite good in terms of the margins, because there's in a way there's more leeway for banks to reprice some of the loans. So in a way, I think margins will be supported under that kind of scenario.
Now, Tamma, again, you also revised your outlook here on the financial operating system of the Philippines from negative to stable. However, you retained your outlook here when it comes to issuer default ratings at negative. Why is that, and how much of that outlook is hinged on the bank's credit profiles as opposed to sovereign support?
Yeah, so right now, in terms of the bank's ratings, they are driven by our expectation of sovereign support. So in this particular instance, the key input to that will be sovereign rating, right? Mm-hmm. So this basically means that the bank's ratings are not driven by standalone credit profile. So the revision that we did in terms of the operating environment, that will not have a material impact on the bank's rating outlook right now. It will basically mean that there is a less downside risk on their standalone profiles. Whereas for their their headline ratings, which is their issuer default ratings. This will continue to depend on the sovereign rating movements. So if there is a downgrade in the sovereign rating movements, the bank's ratings are likely going to be downgraded as well. But on the upside, if the sovereign ratings are actually stabilized, then we will also see a similar kind of revision on the bank's rating outlook as well.
Are we expecting also an upgrade or at least an improvement here when it comes to sovereign ratings, considering the level of growth that we posted in the first quarter? At the same time, you have the central bank already on an unwinding mode.
Yeah, I really can't speak on behalf of my sovereign analyst, but what I can speak is that I think it is an encouraging sign that the macroeconomic performance is something it is relatively quite strong. Going forward, I think we do want to see how whether or not there is still some sort of a scarring from the pandemic, and whether or not this inflation dynamic will continue to remain some sort of a persistent feature, which could dampen some of the economic growth potentials going forward, right? And beyond that, I think the sovereign team also flagged on some of the the economic policy agenda, as well as this fiscal consolidation plan that the new administration is thinking about. I think right now it's still quite evolving, right? Things are still in transition. So I think it's something that we are closely watching at, and will probably determine on the trajectory of the sovereign rating going forward.
Okay, but in terms of that, just to nuance that a little bit, are you flagging still a risk in terms of the debt to GDP ratio above, let's say, the threshold of 60% psychological barrier, and whether or not we will be able to pay that back or reduce that with the current policies or the fiscal consolidation plan that the government is touting?
Yeah, again, I think this is something more of a sovereign rating kind of a question, but I think based on what I understand so far, I think at the current level they are quite concerned where they are at, and I think they would like to see some sort of a consolidation going forward, and some sort of a decrease in the debt level going forward, and that will definitely depend on some of the new policies that the new administration will probably enact. So the fact that right now it's still a negative outlook, I think I would say that I think that the team is still relatively quite concerned about that.